This podcast is for informational purposes only and is not an offer or solicitation of an offer to buy or sell securities. SNN Network, SNN Inc., and the Planet MicroCap Podcast and the representatives are not licensed brokers, broker-dealers, market makers, investment bankers, investment advisors, analysts, or underwriters. We do not recommend any companies discussed. We may buy and sell securities in any company mentioned and may profit in the event those securities rise in value. We recommend you consult with a professional investment advisor, broker, or legal counsel before purchasing or selling any securities referenced in this podcast.
Firstly, thank you all for sticking around and really just participating, engaging with the full day of keynotes, panels, stock pitches. I mean, this has been such an awesome turnout, and we're really just excited for, more to come in the next couple days of presentations, one-on-ones, all that good stuff. And then, of course, right after this, I promise, is a networking reception. It will be at 7 p.m. at the Paris Pool. But for those of you that, I think most of you in here probably have listened to at least one episode before, but I host a podcast called Planet MicroCap. I've been hosting it since 2015. The whole goal for this podcast was I wanted to become a better microcap investor myself, and I wanted to really share that journey with everyone. And the part B of the genesis was I had a lot of fraternity members be like, wait, what are you doing? Microcaps? What's that? I was like, I'm just going to start a podcast, and I feel like that this will, you listen to them, so those will make it easier. But I'm just very grateful to any and all of you that have listened to even one episode. It's really just flattering and just, yeah, thank you. So this is our live podcast. This is how we close out every conference on our Tuesday. And got a pretty epic panel here that's joining us for this. So we got Tom Bachrach from PFH Capital, Whit Huguley from River Oaks Capital, as well as Jason Hirschman from Hudson 215 Capital. So, gentlemen, before we get into some of the topics, questions that we wanted to cover today, love to get some of your background and as well as your fund mandate and philosophy. So, Tom, you want to kick us off?
Yeah, so I'm Tom Bachrach, PFH Capital, long only, value oriented. We're a small fund, which is why we're at a microcap convention. Obviously, we fairly concentrated approach. Our best 10 to 20 ideas. We're long term, so our turnover's low. Maybe adding 1, 2, 3, 4 ideas a year, and if I work hard, which I usually don't, so usually it's closer to about 2. And we obviously prioritize a lot of the same things other people do. We like insider alignment. We like, we like strong balance sheet. I guess the thing that would distinguish us is we take a very international focus. Very little in the U.S. We're in countries from Niger to Kazakhstan to Egypt to Poland to Peru. My basic idea, and this has been an idea for the last 6 years, and I can't say it's been entirely correct so far, but it's is that just simply the opportunities are better overseas. The quality you can get, the growth you can get for the price you pay is just more attractive there, and I'm attracted to those markets. I find there to be a lack of competition. Earlier today, Ian held up a thing talking about where stocks have been profiled from and to show how global it's gotten, and I think I saw that it was like 2% were in Asia. And so I see a thing like that and go, well, I'm going to be in Asia this year, I guess. So
there
it's
you go.
yeah, so that's us.
Well, and real quick story just to show his dedication to international markets. When we first met, we were bonding over, I guess, it was an airport in, was it Turkmenistan?
It was Kyrgyzstan.
Kyrgyzstan, excuse me, I apologize.
And I had a limit order in for it, and by some sheer absurd thing, Cuppy wrote it up because he'd been traveling there, and the thing 4x, and I never even got a single share, and it was so liquid that one Kyrgyz guy, just slamming the ass would have probably done that. So it's
Wow.
So that one wasn't a success story, but those are the types of it was like a 50% dividend on an airport. It looked attractive. So
It was a
if
great,
I've been able to buy it.
great
so.
story at the bar for sure.
Yeah, so.
Whit, background and fun mandate.
Yeah, sure. My name is Whit Huguley. I run a fund called River Oaks Capital. Been running it a little over 5 years now. It's a microcap long-only fund. We own 10 to 15 companies at any given time. Born and raised in New Orleans, I actually worked for a startup company for 5+ years out of college. and I went back to get my MBA at Tulane in New Orleans, thinking that I would start my own startup company. And I guess this was about 12 years ago. Took an investment analysis course, read all of Warren Buffett, read all of Ben Graham, and just totally fell in love with value investing, and just did a complete 180-degree pivot. The plan was to start my own startup company, and just dove headfirst into finance and investing. So for there, moved out to California and worked in private equity for a while. Looking back on it, I got really lucky, and I really didn't even realize it at the time, but I worked for a large private equity fund. They're a pretty large private equity fund, but there was only 5 or 6 people on the deal team, so I got to do anything and everything. And that's, I really learned what rigorous due diligence means, and I wrote down the quote here that Warren Buffett always talks about, that shares are not mere pieces of paper, they represent part ownership of a business. So when contemplating an investment, think like a prospective owner. So when I was at private equity, I really learned that there was so much more behind the financials of a company, the human aspect of running a company, and the day-to-day involvement that goes into running a company. The private equity firm I was in was investing in what would be considered microcap companies. They were obviously private, and I noticed how inefficient it was. And once I started looking on the public side, I realized that it was even more inefficient on the public side, and some of that's for good reasons. But ultimately, the goal was to start my own public fund. So in 2020, I launched River Oaks Capital. And, I think the 2 ways we differentiate, or I differentiate myself, was the first aha moment I had was right when I launched the fund. I started doing the same rigorous due diligence we did at private equity, which was going to visit management teams, going to conferences, talking to competitors, talking to industry experts, doing everything you would do if you were about to buy. Oftentimes we were buying 49% of a business in private equity. And I was just shocked at how few people were doing that in the public microcap space. Obviously, a lot of people here are doing that, but there's oftentimes I go visit a microcap company and I'll be the first person to visit in 5 to 10 years. So I was just shocked, and I realized that was the first way that I could really provide value to my investors. And then the second way kind of developed further down the road, which is what I would call suggestivist investing, where I'm going in, before we even buy ownership in any company, I'm meeting with the CEO in person. And the first couple of years of running the fund, I was just analyzing, if they were trustworthy, if they were capable. Now when I'm meeting with the CEO, I'm often recommending buying back shares, selling non-core assets, that type of thing. I'm never telling them by any means how to run the company, but some of the how to reallocate capital back to shareholders. So that was the 2 aha moments I had of how I could provide value to my investors. And it's been 5.5 years now, which is crazy, but it's been a really fun ride. So,
for sure. And I think Whit has probably traveled more, I don't want to say international, because like these 2 probably have you beat on the international front, but at least domestically, probably more so than quite a few investors I've talked to in recent memory. But Jason?
Just make sure this testing 100% tariff, 200% tariff, 200% tariff. Okay, it works. That's good. My name is Jason Hirschman, and I run Hudson 215 Capital, a family office based out of, sunny Las Vegas. Mm-hmm. First, I was a full-time businessman, and then I became a businessman and an investor. And because of a respectable degree of success, now I'm a full-time investor, exclusively focusing on microcaps and small caps. Now, if things go right, I will continue to be a full-time investor, looking for really like the future great businesses, but when they're teenagers and awkward. But if things go wrong, really, really wrong, well, then I'll be a part-time investor and part-time Walmart greeter, and pointing out where the Made in USA TVs are, and where the Made in USA bath towels are, and where the Made in USA bicycles are. So we'll see how it goes, Bobby.
Very cool. Very cool. So, I'll come right back to you. The first thing I'm sure is on top of mind for everybody, but also I think everyone's thankful that they're here to not be in front of a screen for a little bit. But look, it's been a wild start to 2025. How have each of you been approaching the bizarre, volatile market conditions? Jason, I'll come right back to you.
Okay, well, whether it's a bull market or a bear market or a volatile market, I think rule number one is always knowing what you own. And look, even if you have a Patek Philippe in your portfolio, you don't have to watch after it for the next generation, regardless of what the advertisement says, right? Or maybe you have an Apple Watch, which needs to be upgraded a few years. Or maybe what you have in your portfolio is like a fake Rolex, right? Which is starting to give you a rash, and for some weird reasons, smells like fermented tofu, right? So, I mean, the nice thing about a volatile market, it gives you an opportunity to see, okay, what can I get from my Patek Philippe? What can I get from my fake Rolex? So I think that's the nice thing about volatile markets, which I think, which we're definitely in. Now, I think the important thing is to realize just because it's on your wrist, it's a fake Rolex, and just because other people compliment it doesn't turn it into a real Rolex. And I think investors can sometimes forget that. One other thing I would just like to say is that I think in a market with significant price dislocations, and especially in microcaps, there's a temptation to structure your portfolio so that you're your hero in the future if everything goes right. Mm-hmm. Right? Because heroes in the microcap world, not just financially, they get really, really well compensated. But they can also, especially if they're a younger investor, they can start up a Substack and frankly make more money from the Substack than they did from their investor. So, but I think that's the temptation, but you really have to watch out because like at Disney, when you wish upon a star, your dreams come true. It's not portfolio management. Mm-hmm. And so you always should be cautious, and particularly in a market where, frankly, one tweet can change everything. It's probably not the time to try and be a hero.
Very good. Whit?
Yeah, I've been obviously thinking about this quite a bit lately. I mean, interestingly enough, when I started the fund in 2020, January 1st of 2020, COVID hit. So the fund was down, I think the first quarterly report I put out, the fund was down 30%. Oh, so this isn't something that's abnormal for me. To be honest with you, the fund right now, River Oaks, is not down very much, and we have quite a bit of cash, so it's actually been quite a good opportunity.
Well, aren't you special?
Sorry, didn't mean to rub it in. But I mean, for whatever reason, I flew over here earlier today. I hate flying, terrified of flying. But for whatever reason, when the markets go down, the volatility just doesn't bother me that much. I have no idea why. I was really fortunate to get tested right when I started the fund. Obviously, they bounced back quickly, but there was a point there where people who had just put money into my fund, I had to tell them it was down 30% right away. But yeah, I mean, so what I have been doing is just increasing ownership in the wonderful companies that we own. Some of them have gotten more attractively priced, but this really is the reason I fly across the country. Is I'm looking for the few and far between A-plus CEOs that are in the microcap world. And the reason I want to invest alongside A-plus CEOs is for times like this, because they're able to navigate, murky, unpredictable waters. Yep. And that's really why I've been trying to, find 2 or 3 of those CEOs every year and invest alongside of them. And I think the other interesting observation I've noticed is a lot of these wonderful microcap companies are so tightly held, whether it's by, it's often by management teams, but other, professional microcap investors, that there's really not a lot of people selling shares right now. And, a lot of the best companies I own really haven't moved much at all, because I think so many people, I mean, I think that it kind of goes into the difference between microcap and where the S&P 500 was, and I guess kind of still is that, you know, a lot of these companies that we were buying ownership in were trading at 5 to 7 times earnings, whereas you had Costco trading at 50 times earnings. There was already a huge margin of safety baked into a lot of microcap companies. So, you know, I mean, what I've noticed is a lot of the just like what I would call wonderful businesses have not gone down that much as recently, and the ones that have, we've just increased the ownership. So, so far it's been a good opportunity, but I've definitely been on the phone talking to every CEO of companies we own. I mean, for instance, we own a company called America's Car Mart that is definitely affected by inflation. And I've been talking to the CEO, Doug Campbell, who I consider an A-plus CEO, and the way he's navigating this is just brilliant. And it's, you know, it's why I meet with him once a year. I've got to know him so well, is because I knew when a time like this came, he would navigate it perfectly. So,
just quick follow-up, and maybe cover in like 2 minutes. Like, what is he doing that you're finding brilliant?
Yeah, I mean, so what he's doing is, I mean, so what they do is they lend against used or subprime auto cars, and they also sell them to it. And he's just backing off right now, and he's just observing what's happening. He's kind of building up his war chest because he knows that a lot of their competitors are about to go bankrupt. He's about to make a lot of mergers and acquisitions. He's cutting costs. He's doing everything. He's thinking 5 years down the road. He's not freaking out and trying to make sure that this quarter looks perfect or anything of that sort. He's thinking 5, 10 years down the road. And so they brought him in 2 years ago. And, you know, his background, his extensive background in Avis, and he's been, you know, all throughout the car world. But really the way he's navigated this has been brilliant. Talking to banks, just constantly making sure we get through this kind of unpredictable period.
Absolutely. All right. So Tom, love to hear your thoughts, and then also maybe segue too, because you know, we haven't talked about tariffs yet, and that's kind of been affecting all this stuff too. So maybe firstly, how you've been handling the volatile, and then also tariffs. We're not going to get political. Let's just, you know, hammer it out.
I'll get a little political. Don't worry about it. It's fine. No, so we, so I mean, I don't care about the volatility. I genuinely don't. I don't know what our holdings do on a day-to-day or weekly basis. You know, we take a multi-generational outlook. I really buy into that. You know, it's not like just trying to sound like cute, you know, Buffett Munger talk. I like, you know, it's. Yeah, I mean, I've had like a potential LP like ask me what my Sharpe ratio was, and I was like, we're not a good fit. I was like, I don't know. How about that? So I mean, I just think, you know, I mean, obviously we're in a world that's volatile right now. It's going to be volatile, I think, for a long time. I think volatility is, you know, in human history, we've never had a world this levered. I mean, we're levered up to an extent that's unprecedented. I mean, you can go back to the post-World War I period and look at Western Europe, and you can draw parallels, and obviously they don't end very well. But, you know, when you add, you know, in a company, if you add a bunch of debt to your, you know, capital stack, your equity values go up and down more. That's normal. It's the same thing in the system. And so I don't think this is something, I don't think it's coincidence that we're having episodes every couple of years, and I think it's going to continue for a long time. As a value investor, it's good. I mean, you know, the whole basis of value investing is we come up with these ideas of intrinsic value. They don't change as much as the stock prices do. And so it's frustrating when there's not a volatility in a market like there was, you know, the previous decade. You want to see prices wildly going up and down. That's quite literally what our strategy is based on. And so, and the last thing I say is, you know, going back to what Jason said, if you know and love what you hold, it makes it a lot easier because you're not looking at it like a stock, you're looking at it like a real business. It's also a lot easier if you're not investing in things that are over-levered. First and foremost financially, but it could be operating leverage as well. You know, you know, in my own portfolio, we have some things that, you know, there's maybe some risk on, but, you know, 80-90% of it is stuff that I just don't even have to think about. So I say that's how we're handling the volatility.
For sure. No,
With
for sure. And
tariffs?
then, yeah, let's go right into tariffs. I mean, especially since you look mostly internationally. I mean,
Yeah.
what have those conversations been like with portfolio companies?
Well, I think so. The way I've liked it phrased is Trump doesn't have a plan, but I think he definitely has an agenda, and I think it's like pretty obvious. And so I think if you look at it, Warren Buffett back in like 2003, I tell everyone, pull up this article from back in 2003. It's Warren Buffett, writing about how concerned he is with the fact that our net international investment position, that's how much foreigners own of the U.S., or how much we own of foreign, outside the U.S. minus what they own of us, net of all liabilities. Buffett in 2003 was apoplectic because that number was negative $2.5 trillion. It's now negative 25 trillion 2 decades later. Like, this is like a serious issue. And if your goal, and this is what Trump's agenda is, and I think it's going to be a bipartisan agenda, is to deal with the trade deficit. Well, like mathematically, the way balance of payments works, you need capital outflows. Just like we finance these deficits with capital inflows, which is a polite way of saying we've been selling the family farm for years and years and years to finance near-term consumption. We're going to have to reduce consumption and basically buy some of our assets back, essentially, and that's what capital outflows look like. How we position for that, it's kind of convenient because that was already very international, but if we have a negative 25 trillion NIP, and maybe that goes to 40 or 50 or 60, but eventually it's going to have to go back towards zero. And when that happens, it's going to be, I think it's a generational opportunity in my investing career to be positioned in securities which are trading absurdly cheap, in net exporters, places like Asia, where all that capital is going to need to flow back into their assets. People, like I said, there were, 2% of the MicroCapClub pitches are in Asia. That's the contrarian play. So that's it. The only other thing I do with the tariffs is, you got to use some common sense. There's going to be first order effects, second order effects, third order effects, fourth order effects. I have no freaking clue what the third and fourth order is, and I'm not really all that convinced I can figure out the second. I don't know that I'm smart enough, but on the first order effects, they're pretty obvious. So we picked up a couple very cheap great businesses over in Hong Kong last year. These are Chinese companies fundamentally. One, for example, is they sell a very popular product. They put it on the shelves in these new thriving Chinese local supermarket chains. They're growing well, and if Chinese consumption is going to continue to go up, they're going to do fine. Common sense says, obviously, if I was looking at that company and 60% of their production was exported to the U.S. for sales, I'd have to, appraise that risk a little bit differently. And so, I'm not trying to overthink it. I'm just trying to look at the basics there and stay positioned for what I don't think this is going to be a straight line. This is going to be a very windy, long route there, but I think there's like a basic math to it of what needs to happen in the next couple of decades. So
For sure. Real quick, are you a shareholder in this company?
I am. Yeah. Did I even say the name? Yes. Yeah. So we're. Yes.
Yes. All right. Good. All right.
I'm a shareholder's mystery company.
And Whit and Jay, so we'll put a button on the tariff conversation real quick. I did a really good job just explaining everything. So, Whit, from your perspective, how are you approaching this? You kind of alluded to it already a little bit with
yeah, I mean, that's why I travel as much as you mentioned, is I've gotten to personally know each CEO of companies that we have ownership in. I'm able to reach out to them, ask them how it's going to affect their company, and if they're an A-plus CEO, they'll give you the pros and cons. They're not just going to tell you, oh, it's going to be wonderful for our company. I mean, if I think through it, as Tom was talking about, first order, second order, I don't see how it couldn't be inflationary. And the lesson I learned last time inflation spiked, I guess that was 2 or 3 years ago, was just be very careful about owning debt in microcap companies with a lot of debt, because it's often variable debt. They have strict covenants, so you could see your interest expense go from 7% to 15%, quite quickly. And then all of a sudden the debt owners might be trying to take equity in the company. So that's why I really try to avoid any company with any debt, especially during inflationary times. But yeah, that's really what it's been. It's just been reaching out to each CEO of the companies we have ownership in, and a lot of these CEOs I've gotten to know for over 5 years now. So we have a really good relationship, and it's I think everyone's concerned, but really no one has any answers of what's going to happen next. It's a lot of just questions.
No, for sure. Jason?
I want to speak to tariffs, but first I just want to make a quick comment, which is that I think with the tariffs, and we've invested a lot internationally, it's easy to get very bearish on the United States. And I think that is a mistake. I mean, we're sitting here in the desert, Las Vegas. So much of the rest of the world, when they see a desert, just looks, and to the extent they can get value, they look underground. They see what they can extract. And here in the United States, look at what we've done. Look at how much value we've created above ground. And that's because of really like American human creativity, which is simply unparalleled probably in the history of the world. So I wouldn't get too bearish on the United States, no matter what happens.
America.
But what I say about tariffs is that I think the approach that we're taking is really just to, instead of thinking about tariffs at a country level, really inquire with the management teams that we're dealing with, which have exposure, and ask about production hubs, right? Because really so many products are there's only a few hubs in the world where things are made. So, do they have experience with moving production to a different hub in the past, right? How easy is it to do it? Are there multiple factories that make an item, right? How many different factories does an item have to touch before it actually gets into their hands? How do they get to the front of the line if they do have to move production to a new factory? Mm-hmm. So I think, always with investing, you want to drill down, you want to get into the nitty gritty, you want to go down that rabbit hole. And I think asking about production hubs is the way to do it.
Very cool. So, we've already talked a bit about it, international companies and opportunities out there. So I'm going to skip that topic because I want to get into a little story time. I think, over the next 2 days, everyone here is about to run the marathon of listening to company presentations and one-on-one meetings. So I'd love to hear from each of you an experience from being at one of these events where you learned something during a presentation and or a one-on-one that helped you towards making the right investment decision, for you, whether that's both to buy or just completely avoid like the plague. And then what did that experience teach you about the type of qualitative due diligence that works best for you? So, Jason, I'll come back to you.
No, come back to me at the
You want to close on that one?
I want to close
all right. Okay, Tom, you go first.
All right, here we go.
Sorry, wait, you're in the middle, so you're going to go second every time.
Now I'm trying to remember what the question was. So here we go. So I have attention deficit disorder. I sometimes don't listen to Bobby when he talks. So
just me.
So So I guess we're talking about what we learned. I'll say this, you talk about, I think you used the term qualitative due diligence, right?
Yes.
Yeah. So
Sorry, just due diligence, fine.
No, I do that at the bar at these events. Oh. I mean, that's the bar is the best place you can ever do qualitative due diligence. And the reason why is really simple. When everyone's standing in a booth and they're all buttoned up and they have their suits on and all that, versus when you put a drink in their hand and it's 7:30 and the long day's over, they'll give you a lot more useful information at that bar format.
Do not cancel your one-on-ones. Don't do that, please.
I'll be taking my one-on-ones in any of the regional bars here.
So are you bringing a bottle of scotch or a bottle of vodka to your one-on-ones then?
Well, you factor it in your analysis of the company, what they choose, obviously. Okay. But it's that's. What I would say is when whether you're meeting with management in person or you're meeting with them on a Zoom call, which is obviously way more likely nowadays for us. One of the things, if there's management out there with companies, one of the things I'd say to you is that investors who've been doing it for a while get really, really, really good bullshit detectors. And we can tell the difference between when a management team is telling us what they think we want to hear, which is often their incentive, or at least it feels like their incentive, and when they're telling us what they would want to hear if they were in our shoes. And we've played games with this stuff. I'm looking at some people over in the other corner of the room who've played these games with me where we'll do calls with like a Hong Kong company, and one of us will call up and be like, I really want to see the dividend increase. The next person will call and be like, cut the dividend and do buybacks. And it's like, we come back and say, good news, they agreed to our demands. It's like, even though they completely contradict. And so, and it's, you know, I had another company, I can't remember the name of this, but it was like a software business. And like, I met the guy at one of these things and I was asking him about his product, and he was like, you know, we're pretty middling and average, you know, it's commodity space. He's like, we're all basically the same. And I almost like bought a stock on the spot. I was like, I love you. This is great. So I you know, once you have, you know, it's, if they're not talking, if they care about their shareholders, that's how they're going to communicate to you. And why would you want to invest with people who don't care about their shareholders? So,
Amen.
So I think that's the thing that kind of would stick out to me.
That's very cool. Whit?
Yeah, I mean, the reason I've been coming to this event for, I think, 5 years now, it's, I mean, if I haven't said it enough already, I think it's incredibly important in microcap companies to meet with the management teams one-on-one. Maybe it's not as important for mid-cap and large-cap companies, but I mean, from my observation, almost every successful investment I've had in private equity and in microcap companies, in public microcap companies, has been because there's an A-plus management team. And I really don't know how you could diagnose that by reading the financials. Or for me, I can't even diagnose it by a phone call. I have to meet with them one-on-one. So what I'm really looking for when I'm you know, coming to this conference is, as I mentioned, A-plus management team, a company that dominates a niche, small, fragmented market, so that they're taking advantage of their small size, and also provides a margin of safety in the price that's it's being valued at, because inevitably there's going to be mistakes, especially in smaller companies. I've seen it in private equity. I've seen it on the public side. That every company makes mistakes, but smaller companies make more mistakes. So I always want a margin of safety. And I think, you know, how I identify A-plus CEO, and I think Tom said it well, you just kind of eventually have a meter that you can detect. But, you know, the way,
It's a BS meter.
yeah, a BS meter.
Bullshit.
Yeah, no. I'm going to get banned on YouTube. So.
Is that the CEO is just talking to you business owner to business owner. Yeah. So they're telling you what they do well, what the company does well. They're telling you what the company does poorly, where it needs improvement, the mistakes they made. They're not giving you a pitch that this is going to be the next Tesla or the next Google. They're being honest with you. And it's a similar conversation that you would have if you owned 10% of a local restaurant and you sat down with the 90% owner. Hopefully they wouldn't just tell you everything that the restaurant has been done well. They're also going to tell you everything that needs improvement. So that's really how I try to diagnose what an A-plus CEO is. And I think, you know, the reason, and also I guess the other things I wrote down is just they have a long-term plan in place. You know, going back to the restaurant analogy, you know, if you have a good customer that's coming to the restaurant, maybe you comp them their meal the first time, and that might show poorly in the quarterly earnings, but that you've just developed a customer for life. So they're thinking 5 to 10 years down the road. And you know, the reason I think A-plus CEOs and meeting with management teams is so important in the microcap market is because if you find a A-plus CEO in as I mentioned, a niche, fragmented, small market, there's almost certainly not going to be any other A-plus CEOs in that market. So they're just going to run circles around their competition, because almost every other CEO is going to be a C player at best, who's just working 9 to 5 to collect the salary. They don't care about the return for the shareholders. You know, they're just the A-plus CEO is just literally just running circles and circles, gaining market share, acquiring other companies. And yeah, I wrote down here, I'm not sure if anyone has read the book Good to Great by Jim Collins, but he calls it a level 5 leader. And I think it's the best description that I've seen of what I call an A-plus CEO is. It says they have a leadership style that is characterized by a powerful combination of personal humility and professional will. They are highly ambitious for the organization's success, but with a modest and self-effacing attitude, prioritizing the needs of the company over their personal gain. And that's really what the more I do this and the more I meet in person with CEOs, the more I realize they're just being honest, open, and telling you the pros and cons. And cool. Yeah, that's how it's.
Awesome. Jason.
Well, I'm gonna tell a little story about a conversation I had with a CEO at your conference. I won't name him. A number of years ago. But a few years ago, I was speaking to a CEO right after he had a one-on-one meeting with another MicroCap Club member, who I'm going to call Kevin O'Shea, because I don't want to use his real name. And I think he just raised his hands and gave himself away, but we're going to stick with the Kevin O'Shea. Well, Kevin O'Shea, if you know him, he can be quite blunt with CEOs, or frankly, any human being. And when I sat down with the CEO, I mean, this guy was on tilt. The CEO spent like 25 minutes like decompressing, right after this conversation. So, there's a Yiddish word called like rachmanis, right, which basically loosely translates to compassion or mercy or empathy. And it's very hard for management teams to like speak with 20 or 30 investors, one after the other, in a loud room, right? And so if the CEO doesn't answer clearly or seems low energy, frankly, he just could be exhausted, right? So I think, maybe someone throw a little O'Shea in his face. So, I think you have to give them a little bit of slack, right, at a conference like this. This is a lot of times you're meeting a CEO for the first time, or the management team for the first time, or even the second time. And they're human beings too. Yep. So, treat them that way.
For sure. And yeah, there's going to be a few companies that I think people in this room are.
Can someone please find security and escort this man out?
I think the strategy you're describing is you need to get a copy of O'Shea's one-on-one schedule. You need to front run it.
Hold on, we should invite Kevin up here to give like one story of a one-on-one. Do you want to? Come on. One one-on-one story that you had that like you just grilled, or just you thought you were going in, you thought you knew it was
just
going.
one thing, this guy has not shown up to a conference for 5 years, so I thought I could bring out the Kevin O'Shea story.
Oh, I love it.
And now he shows up.
So you have to know that my Twitter account is the Good Prick,
Yes.
because we were here at a session one time, and Steve comes up to me and he says, I hear you're a real pain in the ass when you're in these meetings. And I said, yeah. He says, are you kind of like a prick? I said, well, if I am, I'm a good prick. So it comes down from that, and yes,
Who gave you the idea, by the way, to make that your Twitter
I
handle?
have a half an hour to find out what's going on. The first question I asked everybody is, tell me what you do in 25 words or less, because at 26, I start snoring. Okay? If you can't tell me what you do, go away. The next question is, why are you the CEO? That absolutely stops them dead in the tracks. They can't answer the question. And it's not I don't intend to have them answer the question. I intend to watch them squirm, to sit down and find out, how do I answer that question? So to that end, you're sitting there asking them questions that they have never heard before. The interesting thing about it is, though, I am very, very blunt, I am very focused, and I shut them up when I want them to. And I think Jason would probably say the same thing.
As Whit may say, you're an A-plus prick.
I am an A-plus prick. But the one thing that happens is this, is that I meet the guys at the bar, and they sit down and they say, that was probably one of the best interviews I've had all day. Yeah. Because it wasn't just, read me the IR deck, tell me what you're doing. I already know what you're doing. And so to some extent, it's a question of just chase them around, find out what's going on. It's fun.
It is fun.
Just don't be a prick.
Can we give Kevin a round of applause? That was just Kevin's the best. And by the way, I just got 3 notifications that all your meetings got canceled over the next 2 days. I don't really know why.
I think that just goes back to just one thing. I think, investors appreciate authenticity.
Yep.
right? And that's the most important quality that a management team could bring to any one-on-one. Just be authentic, be as honest as you can. I know sometimes you can't disclose everything. And just admit the positives and the negatives. And do it hopefully in a succinct manner.
That's awesome. Yep. All right. Final question, story time that I got for you guys. We covered that on the topic of due diligence. All three of you have traveled the globe doing site visits with companies and, for your follow-on due diligence. So I'd love to hear an experience that has stuck with you or you learned the most from doing some of these site visits. So Jason, do you want to close again or do you want to open this one?
I will close.
Okay. All right. I'll go to Whit first. Whit, you do this and then I'll go to Tom.
All right, sure. Yeah. I guess the first story that comes to mind is what I wrote about in my most recent letter was right when I started the fund. I guess it was a couple months into it because there was COVID restrictions.
Yeah.
I went to go visit the company, and I got dressed in a suit and tie, like we would always do in private equity before visiting a company. And I walked in, and they were just like, "What are you doing here?" They were like, "You're the first investor that's been here in 5-10 years," and the first 15 minutes of the conversation was them trying to analyze why I was there. I was just like, I'm just trying to learn about your company. And that's really where I had the aha moment of I can just provide value to my investors just by going to visit these companies in person. But the one that really sticks out to me and the one that changed the course of how I think about investing was, I think it was about 4 years ago, I flew out to Fort Worth to have barbecue with Dayton Judd. We own Fit Life. I think he'll be here tomorrow if I recall. And that was the first time I sat down with the CEO and I realized there really is A-plus CEOs that I keep referring to in microcap markets. There might only be 50 in the US. I'm not sure what the number is, but there's enough to make a 10 to 15 company portfolio. But I sat down with Dayton and he knew the business inside and out. It was immediately apparent to me that he could run a Fortune 500 company if he wanted to. He just preferred to run a small company. And he, once again, as I've mentioned multiple times, he just talked to me business owner to business owner. What's been brought up is he was candid. He was like, here's what we do well at FitLife. This would have been in 2020, 2021. And here's what we do poorly, and here's where we need improvement. And that really changed the trajectory of what I was doing. As I was flying across country to identify the few and far between A-plus CEOs that are out there in the U.S. In public microcap land. And I mean, since then, I've made recent investments, or we bought ownership in Innovative Food Holdings, which I see a lot of similarities in Bill Bennett that I saw in Dayton. Hape, which I saw. Gavin is here. Right now. Hype.
Yes, hype. Sorry, Gavin.
I saw Gavin was here, and I see a lot of similarities.
I did the same thing the other day. I'm sorry.
To him as I saw in Dayton as well. So that was really the visit that changed everything for me because. The reason I was visiting all these companies, there were so many companies I was visiting where they would be trading at 5 times earnings. I was so excited to get on a plane, and I would get there, and the second I would visit management team, I would be like, this is a totally uninvestable situation. And I realized you'll probably only find 1 to 3 per year, but when I sat down with Dayton, it was like, okay, this is what an A-plus CEO looks like, and they do exist in microcap companies. So
heck yeah.
That's the having barbecue with him in Fort Worth is the one that really sticks out to me.
Very cool. Tom?
Yeah. This is recorded, right?
Yes.
Yeah. All right. Well, I don't think I can tell any stories then from any of my overseas visits at all, really. But no, I'll be honest with you. I've actually been traveling way less the last couple of years. My main reason is I have 2 girls who are right on the edge of being teenagers, and I feel like they're going to be in college soon, and I don't like, you know, if I'm going to go halfway around the world to check on an investment in Kazakhstan or something, you know, I'm gone for 2 weeks, and I don't really want to miss them. So, you know, it's, yeah, I miss them. And my wife's name is Whit, by the way, so you have big shoes to fill the next 2 days.
Is she A+?
Yes, yeah, A+. A+. But I think what's been interesting is that, like, you actually, I still think there's tremendous value in going overseas and traveling and kind of going on these adventures and doing all that. And I look forward to, like, really, really upping that like crazy, you know, once my kids are out of the house again. But, you know, I've gotten away with it, I think, the last few years because technology is so amazing that, you know, I'm on Zooms with people, we're texting over, you know, whatever messaging apps, and, you know, like, it's really important, like, if you want to invest in Kazakhstan or Poland or wherever, to have a really trusted network of investor friends there. I call it the gringo check. You know, I can basically have what I think is the best idea about an investment in a country that, you know, I've never lived in, and okay, fine, maybe I visited for 2 weeks. I doubt I came away with a deep understanding. I've lived in countries for years before, and it takes a long time to actually really understand a place. So just to have these people who actually live there and speak the language, who are collaborating on ideas with you and telling you when you're being an idiot, is huge. When I do travel to unique places, so yeah, we were in Kazakhstan for a couple weeks, like 2 years ago. About my biggest hack I like to do is places like that. So we were looking at certain mining businesses and stuff like that, and there's only one or two, and actually often it's just one bar where all the, I'm back to the bar strategy, I look like a massive alcoholic. There's only like one place where all these expats who go and work for all these, like, you know, these companies go and hang out every single day. They're like there at 5 o'clock like clockwork. And so I go there and I figure out what that is, and I say, well, I'm going to be a regular here for the next 3-4 days. And the amount you learn just talking to all these people who've been living there for a long time, they've been working with like the local government, they've tried to develop projects, they all know about all of each other's inner dark secrets. It is remarkable, and so you'll learn way more than sitting in a nice clean office talking to management. I'm not saying you don't do that too, but you know, you learn a lot. And in Kazakhstan, I'm just going to shamelessly plug it, that bar is called the Shakespeare Pub. And if you go there, say hi to Sam for me. So.
Nice. Jason?
I think Tom makes all of the most important portfolio decisions in a bar, it seems. I think that's why the tariffs don't bother you, right? Or the volatility doesn't bother you.
Yeah, I have a little bit of Irish in me, and I have some Eastern European. It's a bad mix. I mean, what could I say?
I think I could say, but I think one thing that's attracted me to Europe, I think when everyone starts making fun of the euro poors, that's probably the best time to invest. Yeah. So, you know, the advantage for me, I think, in Europe, as we see it, for microcap investors, is not that there's better classic value stocks. I think there are, but there's always been a sizable group of European investors, value investors, who stayed loyal to Europe because of the multiple difference compared to the USA. I think what Europe lost, in essence, are its growth investors who just gravitated to the American markets because of our tech boom and our growth stock boom. And frankly, if they're microcap investors, because of our more developed like microcap ecosystem. But I think the small growth stock market in Europe is actually the most interesting space in Europe. So I think since you're in the room, I'll mention them. Like, you know, look, we do this in the United States. I think when my son Evan contacted Hype Group, you know, the world's leading online retailer of nicotine pouches, we were one of the first, I think, to speak with them. You know, when we visited them at their headquarters in Stockholm, I think we may have been the first outside investors, and he's nodding, so I'm getting confirmation from the CEO. Not only the first overseas investors to visit them, but I think maybe the first investors to visit them. Now, they were ignored growth stock, you know, and of course their association with nicotine didn't help at the time because people really didn't understand nicotine pouches as much as they do now. But I think in the Nordics, you know, you can get a safer business model, you know, higher quality management at a much lower salary cost than North American teams, and a focus on both growth and profitability. You know, reasonable share compensation, more transparent and trustworthy communication with investors, plus some diversification, which still, from what is still a strong dollar. So, there's a perception that USA microcaps get a higher multiple, but I wonder whether that privilege will go away if foreign stocks start grabbing the leadership mantle from the USA. So I just want to close it off by saying, thank you, Bobby, as always, for hosting this and for putting on a really tremendous conference. It's really remarkable of how much better it gets every year, and I think you do a A+ job.
Well, thank you guys, man. This is great. I really appreciate you guys joining me on this panel today. Look, we're about 6 minutes away from starting the pool, but one question, two questions, if anybody has one.
Yeah, you said A+ CEOs multiple times. What do you exactly look? What's your standard? Do you look at return of equity mostly as well?
Good question.
Yeah, I appreciate the question. I mean, what I'm really looking for is kind of what I mentioned when I sat down with Dayton Judd, I guess 5 years ago, is someone that's honest. Obviously, they're capable. They have a long-term plan. Obviously, they're going to have a great return on equity if they execute on the path that they've laid forward. If you go back and look at FitLife stock since 2020, especially since Dayton took over in 2018, the performance has been remarkable. But I mean, it's really someone that, as I mentioned, if you find someone that's an A+ CEO, that's honest, treats you as a business owner, is driven, smart, just checks off all the boxes of someone that you would want if you were to buy a local restaurant, someone that you would want running that restaurant. They're going to run circles around the rest of their competition in the microcap area. And the other part of it is an A+ CEO that is in a fragmented, small niche market. If you have an A+ CEO in a microcap company, but they're trying to go against Tesla to bring them up again, or some enormous company, that might be a feat that's hard to overcome. But if you have one that's just dominating just an obscure, underfollowed market, that's where, personally, all my best investments have always come from, is backing them.
Can I just add one thing?
Yeah.
Which is that I think you mentioned return on equity. And I will say that if you want to make good money in the microcap space, you can wait for a company to make a good return on equity. But if you want to make great money in the microcap space, you have to invest before that company earns a return, a very good return on equity. So now you're really making a judgment about the management team. You're making a judgment about their business model. You're making a judgment about the competitors and the industry landscape. But that I think making those decisions and pulling the trigger to buy before it actually gets into the numbers is really how you make the life-changing money, to the extent you can.
And we got one more question, or
yeah,
we'll do two.
So, talking about great money, this question is for Jason. I know that you have many multi-baggers, but when do you sell? When do you think it's enough?
Oh. Look, to be honest with you, I'm going to be very honest with you. I think I'm pretty good at finding companies early and choosing which companies to buy. I think I'm probably very, very good at holding on to companies. I think it's still a judgment call how good I am in terms of determining when to sell. So I'm not sure whether I'm the guy to answer that question for you, but I'll try to give the answer the best I can. I think what I tend to do, and it's usually, I never usually get the top, because I usually give the management teams a lot of slack. But I think in some ways it comes down to confidence or lack thereof. At some point in time, and it's usually not even like a conscious thought. It's just it's like a back of the mind concern that you have that pops up occasionally, right? For me, I could be in a shower and someone just some thought, enters into my mind. And the experienced investor starts to really trust their like little subconscious or just little concerns. That said somehow they just lost the edge, right? And and it's tough. Microcap companies, as they grow larger, like things just slow down, right? It happens to all companies. And there's a lot of times I find, there's some management teams who just, they get comfortable, right? And really, you always have to have a degree of discomfort, right? You have to really want to do better. You always want to take the next step. And sometimes it's people reach a certain point in the mountain, they're like, this is high enough. So you have to judge the management team whether like they're just comfortable with where they are and they don't want to go that much higher.
Yeah, if I could add on to that, I mean, when I talked about, I guess it was 12, 13 years ago now, when I got obsessed with investing, I think I read in 2 years maybe 100 investing books. It was, it was an over-obsession. And the one answer I never heard, the one thing I never heard a good answer to was when to sell. I never heard anything that was like, oh, that makes perfect sense. It really does seem like a formula you have to develop yourself. And I've never heard the perfect answer to that question. I think even Charlie Munger, a year before he passed away, said he doesn't even have the right answer. So,
or I'll give the right answer. It's opportunity cost.
All right, well, in the interest of time, we want to just thank you guys for joining us today. Thank you all for being here, for just experiencing this day one. And yeah, let's go to the pool. Follow us.